to be hearing from her later, but we're going to start with Sam. Now, I had the pleasure of hearing Sam pitch at Eco Summit recently, and talking about ETIndex, which we'll be talking about. This is a carbon accounting and a ranking system. He's told me that it's not going to be pitched tonight, which is great, because that's we're going to get something a bit more relaxed. So I'm looking forward to hearing from Sam. Over to you. Thanks very much.
Thanks very much, everyone. Hi, everyone. My name's Sam. So just to give you a bit of background, I started my career working at Google, and then I went on to run the Environmental Investment Organisation, which is a not-for-profit research body focused on ranking the biggest companies in the world based on their carbon emissions. Just over a year ago now, we created ETIndex with Climate King, which is an EU initiative designed to support climate-related companies. So what I was going to do really, just given that it's COP21 kicking off today, I wanted to really just provide a little bit of context before. All good. Okay, thanks. Not actually. I decided to drop the slides this evening. I feel like at this time of the evening on a Monday, you probably don't want lots of slides. So yeah, just to really provide a little bit of context. What's it all about? So I think the first thing I want to say is that I am feeling a little bit more optimistic. I think that they've gone about it the right way this time. But actually, it's this time around, the pledges that have been put forward, I think we've now got something like 184 countries out of something like 195 have pledged and have a now concrete decarbonisation plan and pathway. So really, regardless of whatever comes out of Paris, there are significant actions that are going to be put into place. And what that means is that for investors, there is now an increasingly large signal that action is happening and materializing. And in my opinion, it's actually not so much the concrete, let's say, agreement that comes out of Paris that, for me personally anyway, is key. It's actually really the perception of what comes out of Paris. And if that perception is that something positive has come out, then it's that will start triggering different flows of capital away from higher carbon, more carbon intensive assets and companies towards a more efficient transition. And I think realistically, if you've been following the debates, we know that whatever comes out of Paris is not going to be enough. The 2 degrees idea, forget about it. But it's potentially enough to trigger the kinds of momentum that can ratchet up and get us there. So I'm more optimistic than pessimistic. I'd say, working in this industry for about 5 years, pretty pessimistic for the first 4, kind of on the up now. So just to sort of, again, set the scene a little bit, talk a little bit about climate change at risk. I think it's really important to remember what it is that we're actually talking about here. It can sometimes get lost a little bit in all these numbers, 2 degrees, 4 degrees. What does it all mean? And I think really one particular scientist I draw upon, Kevin Anderson, he's one of the most outspoken in the scientific community that really sort of tells it like it is. And basically what he's saying, and this is also, I think he's pretty much putting us on course for 4 to 6 degrees of warming by the end of this century on our current path. And if you look at reports from the likes of PwC, they're corroborating that. We know that that's the trajectory we're on. And what he's essentially saying is that that is not compatible with an organised global society today. And what that will essentially mean is that the carrying capacity of the Earth in terms of the number of people it can sustain, so I think we're going to be around 9-10 billion by the end of the century, would be reduced down to about 500 million. So that's potentially 1 in 20 people surviving at that kind of point in time, which I don't know about you, I've been sort of, I'm not in the sort of position at the moment to be having children, but it's like, do I have children, don't I have children, are they going to be in the 1 in 20? I don't know, we live in London, maybe we're going to be okay. But the point is, it's not a good situation. And I think from a moral point of view as well, it's going to be a lot of suffering as we transition in that way. So there is definitely an imperative, and I think that's why the Pope has most recently got involved. So that's what I'd say about climate risk. What is that all about? Talk a little bit more about carbon risk from a kind of financial point of view. So many of you might be familiar with the idea of the carbon bubble, which was an idea that was put forward by a group called the Carbon Tracker. And basically what they're saying is that if we're going to limit global warming to no more than 2 degrees, the one thing everybody has agreed to, then that means that we have a carbon budget from now until the end of time. And if you look at the embedded carbon within the fossil fuel reserves of the largest 200 listed companies, that number is about 5 times greater than the amount that we can burn. And even if we sort of just burnt that amount, I think it's still something like a 1 in 5 chance that we, or a 50% chance we solve the problem and don't go beyond. So, we're already playing with fire on a massive scale. But the point is, if we're not going to blow our carbon budget and surpass this 2 degrees limit, then it means that an awful lot of fossil fuel reserves are going to have to stay in the ground. And therefore, if you are an investor and you're very heavily exposed to oil, gas and coal companies, coal has already kind of died, but oil and gas typically makes up a very substantial proportion of our stock market indexes, which, by the way, is where a lot of our pensions are invested, then suddenly it becomes more of a financial issue, and analysts and fund managers are starting to think about this as, actually, am I going to be the last one left holding coal, gas, all the rest of it? And there's also this idea that actually, a lot of the capital that is being invested in projects like drilling in the Arctic is actually, in fact, completely wasted capital, because we can't actually dig it out of the ground anyway. I think it was Shell that just wrote off very large projects in the Arctic. So basically, this idea of carbon risk is starting to diffuse itself within the investment community, and I think it's a really key and very sensible strategic move by this carbon tracker group to try and couch it in terms that people really understand in that community. And it's actually that, I would say, coupled with the divestment movement, which you've probably read about or know people involved with, which is really galvanizing a lot of support across particularly universities, but it's kind of gone beyond that as well. And where investors are saying, actually we're going to take our money out of fossil fuel companies altogether, mainly it's a sort of mix. The chair from the Guardian, for example, was saying, it's on the one hand a financial argument, and on the other hand a moral argument, and it's very hard to split the two. So I would say this idea, carbon risk plus divestment has really started to generate momentum within the investment community, which could well lead to very positive things to come if we can continue to push it that way. So, I think just maybe a couple more points, and then I'm going to talk a little bit more about what we actually do to give you a bit of an idea there. So, I think one is really this idea of emissions versus reserves. So, within the, and this is kind of slightly more technical points, but I think it's just interesting to share a few thoughts on that. So, within the divestment community, and within this idea of the carbon bubble, it really looks very much at fossil fuel reserves. And that, because it's quite a simple idea, has gained a lot of traction. If we leave the carbon that is embedded in fossil fuels in the ground, we'll solve the problem. And that's great. That makes a lot of sense. But it somewhat actually detracts from the real problem, which is greenhouse gas emissions, the actual gases themselves. When they're left in the ground, that's job done, they're already there. But it's the emissions themselves that are causing the problem. And therefore, in the debate, it's just something to be aware of, that actually, if we're looking at the complete value chain of a company, so it's direct emissions, the emissions that come out of the chimneys that a company operates, or perhaps the electricity that it purchases, or its supply chain, and if you cover that entire scope, you really do address the problem head on. You capture all of the emissions that are ultimately causing global warming. And so that's perhaps a slight critique I would have with the divestment movement, which, although it's great in terms of generating momentum, and this is often what campaigns are about, they keep it simple, they focus on one target. But by virtue of looking at companies just based on their reserves, they're somewhat letting off the rest of the economy, which actually is driving the problem. Fossil fuels is certainly not just a supply side problem, it's also a demand side problem. How many of you have in some way used a product or service today that has had fossil fuels involved in it? It's pretty bloody hard to avoid in today's modern infrastructure. So just something to be aware of there. And then I think that the sort of the last point I want to just make on that, sort of following on from the divestment debate, is really this battle that is sort of pitted against each other between the idea of divestment, where you take your money out, which is in some ways the most extreme thing you can do in investment terms. You know, you no longer hold any shares in that company, versus engagement, which is this idea that by virtue of owning shares, you can then interact with the board and have your vote at the annual general meeting. Now, engagement has got a pretty bad rap because basically it hasn't achieved anything in the last, in the last 20 years. You know, it hasn't solved the problem. We still have climate change. We still have Exxon and whoever else, drilling in the Arctic. So these are often sort of pitted against each other. And I guess what I want to say is that actually there might be a sort of a middle ground in that debate, as with so many debates. It's not black or white, there's a bit of grey. So if you can combine the two, this idea that, and this is one of the things that the leader of the Confederation of Trade Unions talks about, she really gets climate change. The idea that you might say to companies, look, if you don't change your ways within X time, we'll divest. But in the meantime, we're going to engage with you and we're going to tell you exactly what you need to do. And I think there is that sort of constructive middle ground that you hit a bit more of the subtleties. So in the next couple of minutes, and I've got a few minutes left, I'm just going to tell you what it is that we do, because now that I've sort of set the scene and maybe the problems, what is ETIndex all about? So the ET stands for environmental tracking. And what we do is we take the largest listed companies in the world and we rank them according to their carbon emissions. And the idea with this ranking is that we're trying to give each and every company a position relative to one another so that they're always in competition. And as you would probably imagine, the lowest carbon companies are at the top, the high carbon ones are at the bottom. There's no great surprises. It's extractive industries, oil, gas and coal are at the bottom, services, telecoms typically towards the top. But the idea of this ranking is not necessarily to sort of create surprises in terms of that ranking. It's actually there to serve a purpose. And that purpose is really twofold. The first component is that it's designed to create a negative PR pressure. And the more people that know about it, and this is something we make public and freely available on our website, the more that companies don't really want to be at the bottom of it every year. Or if they are at the bottom, they don't want to be quite at the bottom. Maybe it's better to be sort of 10 places up and your competitor is at the bottom. So there's always competition wherever you are. But what it's really there for, and this is in the name, is to underpin a series of stock market indexes. So indexes that are basically exactly the same as the FTSE 100 or the S&P 500, for example. They contain the largest listed companies, and they're based on market capitalization. So for those of you who are perhaps less familiar, normal stock market indexes are based on market capitalization, so pretty much the value of the company. And so if a company's value within, let's say Tesco's, for example, is worth 10% of the FTSE 100, then if you're tracking the FTSE, so we talk about index tracker funds, then 10% of that fund will be used to buy shares in Tesco, and the rest of your money will be spread across all of those companies. There's an awful lot of money invested through indexes. Pension funds around the world typically invest between 25 and 35%, and that's projected to double within the next 5 years. Their money is going in indexes. So that's an awful lot of money that is moving together in unison in one place. And really at the heart of this concept is the idea that actually if you can just redirect that capital slightly based on a public, fully transparent ranking of all of these companies, which includes the full scope of their emissions, then you can actually start to shift the demand for company shares. And given that price is ultimately a function of supply and demand, if you can change one of those variables, you can start to change the price, provided you get enough capital following these indexes, and obviously that's the challenge. What was I trying to say before I went off on another tangent? So basically the ranking companies, creating indexes, and as I say, that's really very much designed to shift demand for company shares. But ultimately, talking about the rankings, PR pressure, but it's also an engagement tool. And it's a bit like what I was saying before, it's sort of slightly more than just words. It's effectively saying, if you move up the rankings, you're going to get more capital going into your company. Now, as companies exist to make money for their shareholders, obviously we've got kicks and not-for-profits, and that's fantastic, but the majority of the world is made up of for-profit companies driven by a profit motive. If you can start to actually link that, so that, every time a company is pursuing an environmentally damaging course of action, it knows that its share price is getting knocked down, then either the board of directors are going to change course, or they're not, and then they're going to get voted out by the shareholders that are going to say, well, what the hell are you doing? This is damaging my investment. And that's basically what this concept is all about. So I'll just show you one slide. So we've created three different, well, actually six, but three sort of models, if you like. One is called a tracker, one is called a benchmark, so this is our middle one, and one is called a transition. And basically what the difference is the amount of reduction you get in carbon. So this is an ETIndex, and this is the normal index. The trade-off, however, as you can see, these lines on the graph are pretty close together. But basically the trade-off is the more carbon you take out, the greater the deviation between the normal index and an ETIndex. So different investors have different risk profiles and therefore will want to be closer to that line than others. We've also created a fossil-free version of each, so if you do want to take out the fossil fuel companies, then you can do that as well. But the only problem I have with that is then you don't have any lever over them to actually drive them to change. And if you are going to divest, then why not divest and apply pressure to the rest of the economy as well, because it's not just about fossil fuel companies. Thanks very much. I don't know if it's questions now or later.
How are we doing for time? Maybe we can have a 5:20. Yeah, we've got time for a question or two.
And I did promise it wouldn't be a pitch, but we are raising money at the moment. And we've got about where are we at to? About 440,000 in the pot, and we're going for 600,000. And we're SEIS and EIS qualified, which means you get a massive tax break if you invest. So even if you don't consider yourself an angel investor, if you're interested in supporting a company working with climate change, come and talk to me at the end.
Fantastic.
Pitch over.
That's fascinating. I mean, I think, what I wanted to say, and I think which you encapsulated really well, is the role of Cleanweb companies like this in catalyzing the transition and creating the conditions, the market conditions that actually allow all the other companies to prosper. That's a really crucial point of leverage in the system. So I think that's really fantastic. Can I just ask before I open it up? Is this what you're saying here is that the ETIndex companies have done better?
Yeah, so it's not really. Well, an ETIndex has done better. What it actually is saying is that low carbon companies, because they're the ones that we put more money into, have actually done better. There's some more quantitative research on our website under the research button exploring that in more detail. But I mean, if you think about it, low carbon is also a proxy for efficiency, good management, and we would argue that we are starting to see,
forward thinking.
Well, there are carbon prices around the world now, so there is a penalty for being a high carbon company, and we would expect that to grow into the future. But that's not our core argument. Our core argument is you can stay close to the normal index. But by the way, I didn't say that, but yeah, it has done that.
Okay, well I've hogged the questions. We have one other question. If anyone wants.
Hello. Is the index used by fund managers or private investors to kind of gauge their actual investment choices, as well as kind of bringing exposure to the poorly performing companies or well performing companies?
Sure. So I mean that's
actually kind of the direct link between the investment decisions that are made. Right?
I think so. We have several large institutions that we hope to be launching our first fund with next year. In terms of the wider market using it as a sort of information point, I would hope that would grow in the future. At this point, it's hard to say, because it is public and freely available. I think I don't think people are factoring in carbon to a material extent at the moment, and that's probably why there is this outperformance, because it's not really being priced into the market.
thanks very much.